Hello everyone, today's video is all about the writing off of a director's loan account. So first of all, what is a loan account? And secondly, why would you choose to write it off? So a loan account, director's loan account is basically the balance that a director has with his or her company. Think about it like their own personal bank account with their own company. And they have deposits and they have withdrawals. Now, when they are in credit, there is no tax issues. So being in credit means that the company owes the director some money and the director can pull that out as and when they like, tax-free. The issues arise when it's the other way around and we say that the director's loan account becomes overdrawn, and that means that the director has pulled out more money than the company owes it. So in other words, the director owes the company. Now, from a tax perspective, the issue with that is if you go overdrawn on your director's loan account, HMRC say, oh, well, okay, if you can afford to make a loan to a director, because in a sense that's what happened, their director's loan account goes overdrawn, if the company can afford to do that, then it can afford to pay us a dividend rate of tax, roughly a third of the amount, and then when the director repays the loan to the company, we will repay your the tax that you've paid on account, the 33%. So what we always try and do is avoid that in every situation possible, because why would you want to pay that money on account to HMRC only for it to be repaid at a later date if you can preempt it by clearing the overdrawn loan account? So in other words, how do you go from being overdrawn in your loan account to being in credit? Well, the obvious thing is to declare dividends. So if you're a shareholder as well as a director, then you're entitled to dividends. Hopefully the company's made a few quid, you've got some profits, and you just declare a dividend, and that will hopefully trip your overdrawn director's loan account back into credit. And the problem goes away of you having to give some of that to HMRC in advance and then get it refunded down the line. You don't even get to that stage. However, what if the company doesn't have enough profits to be able to do that? And you get to the deadline for this, because the deadline is that you have to make good your overdrawn director's loan account within 9 months of the company year end. So normally, as long as you voted those dividends or even voted extra salary to clear the loan account, not a problem. You don't have to pay this extra tax on account to HMRC. However, look at this scenario here. We've got a balance sheet and fixed assets, 50 grand, cash, £30,000, debtor, director's loan account. So this is an overdrawn director's loan account. Director A owes the company 20 grand, sits in the balance sheet as an asset. Creditors, £90,000, the company owes out. Net assets, £10,000. So that's just a snapshot of the top half of the balance sheet. What's on the bottom half of the balance sheet? Ordinary share capital of £1,000. For some reason, this company's got a share premium account, £15,000. And then the P&L balance, the reserves, the cumulative reserves on the P&L account, minus £6,000. Shareholders' funds, £10,000. Obviously, it's a balance sheet that balances. So in this scenario, there is P&L reserves balance minus 6,000. Now the key to pay a dividend legally is that figure needs to be positive. You cannot pay dividends out of a company with negative P&L reserves. So we've got a bit of an issue here, because unless Director A repays the 20 grand that he owes the company within 9 months of the year end of the company, HMRC are going to say, you know what? We'll have £7,000 tax in advance, please. And then when he eventually does get around to settling with the company, repays the 20 grand somehow, we'll refund the 7 grand tax. That's the scenario that you don't want, because it's lousy for cash flow. Why would you pay an extra amount to HMRC just to have it refunded down the line? So this is what thousands and thousands of business owners do. They will always make sure that they repay this within 9 months. But in this scenario, we can't, because negative reserves. So what to do? Well, one of the things to do is to write off the loan account. The company just writes it off. So the company says to the individual, you don't need to repay back the loan account, the 20 grand that you owe the company, we'll just write it off. Now in the company accounts, what would that look like? Well, the £20,000 would go from the balance sheet. It's no longer an asset because it's not recoverable. It's not going to be realised. So you're going to debit the profit and loss account and credit the balance sheet. So that disappears, but it becomes an expense in the P&L. It reduces the profits. It's like any bad debt that's written off. However, for corporation tax purposes, there's no CT relief for the company. HMRC say, look, perfectly acceptable to do this, but you're not going to get tax relief for the write-off of the loan. Well, that's fine. So when he comes to do the company tax return, it's just added back. So whatever the profits say in the accounts, you add back 20 grand as a starter for 10. So no CT relief for the company. But crucially, what about the individual? Because the individual no longer has to find the £20,000 to repay. Remember, we can't pay him or declare a dividend for him because we haven't got reserves. But thankfully, the legislation allows us to treat a loan write-off as if it was a dividend. So in his hands, Director A, he is taxed as if he had received a £20,000 dividend. In other words, exactly what we would have done had this negative reserve figure instead been positive. If this figure was at least 20,000 instead of minus 6,000, we would have just declared a dividend and he would have been taxed on a dividend. But the write-off affords us the chance to actually treat him the same for his individual tax as if he had a genuine dividend. So the write-off, as far as he's concerned, he is taxed on his tax return, it's called a deemed distribution. In other words, as if it was a dividend. Deemed distribution, taxed as a dividend under the regular rules, the rates that apply to dividends. So depending on what else he's got going on in the year, the dividend tax, as we know, the first £2,000 is zero, then the balance of the basic rate band is 7.5%, then it jumps up to 33%. But essentially, it's taxed as if it was a dividend, even though it's not a dividend, because legally we can't afford to pay a dividend because we haven't got enough reserves in the company. But that's a great solution to an overdrawn director's loan account problem if there are not enough P&L reserves on the balance sheet to cover paying or declaring a dividend. Remember, we're not actually paying because he's already had the money. This is just a paper exercise to trip him back from being overdrawn into credit. He's already had the advance. We're just tidying it up and saying, well, actually, we're going to declare a dividend to bring you back on paper in your loan account into credit. And this is how thousands of businesses work. But I would suggest that the awareness of the writing off of loan accounts isn't as common as in other areas of paying dividends and entrepreneurs, tax reliefs and various things that small business owners do. But it's something absolutely that's available to you if you are in this situation and the P&L reserve is indeed negative, so you can't legally pay a dividend. Okay, so that's just an overview there on writing off directors' loan accounts. If you like this video, please do subscribe right about there, and I'll see you soon.